the Eurozone story is also one that's challenged. And so that's what we're going to see also in the data. So we look at their GDP data. We saw the Euro area economy unexpectedly stall in the last 3 months of last year, following a 0.1% contraction in the previous period, as compared to a forecast of a 0.14 preliminary estimates have shown. So what's that mean is that the common bloc avoided a recession in the end of 2023, but only just, amid a better than expected growth from Spain, 0.6 of 1%, Italy 0.2 of 1%, while the French economy stalled, as did Germany, which is the largest contraction, which was 0.3 of 1%. Now, in terms of positive contributions to GDP, also came from some of their other smaller economies, which was Portugal, 0.8 of 1%, Belgium, 0.4, and Latvia, 0.4, and also Austria, 0.2. Now, on the other hand, we did see contractions in Ireland, negative 0.7 of 1%, and Lithuania, negative 0.3 of 1%. Now, considering the full 2023 data, the Eurozone GDP expanded by a paltry 0.5 of 1%. What do you make of that, Evan?
So this, unfortunately, is going to slide into politics. So we saw the Eurozone have this renaissance in their post-COVID era, where you just saw this absolute explosion as they came out of lockdowns. European exports. When we say exports, tourism is a great example. Don't forget, tourism is an export. So the attraction into Europe was incredible. If you look at those sort of tourist hotspots, France, Italy, Spain, Portugal were really driving that on that being one of the biggest drivers. Don't also forget, Germany is the largest exporter out of Europe. France is second. And that means luxury goods were also bang up across the globe. So if you have a look at what was going on in the second quarter of July 2021, third and fourth quarters, that explains that. And then there was this suggestion that Europe was back. Europe was going to really be this place. Then Ukraine happened. So we need to put that out there very clearly. Ukraine has been a massive drag, clearly. Tourism fell immediately, particularly in those nations I mentioned before. Obviously, there's a risk around your own personal safety, blah, blah, blah. Then also, they came up against supply constraints. And so 2022, which should have been a better period than it was, started to moderate. Last year, it's back to the big, bad, old scenario for Europe. They are bickering between each other. They've got, issues around finance with what's going on in Ukraine. Also, some of what we refer to as the periphery, your Latvias of this world, your islands, are also dragging on the overall, GDP economy of the whole unit. Plus, now we have the Middle East conflict as well. So as I said, don't forget, Germany, France, massive exporters and massive global exporters. They are having issues around getting it through what's going on in the Mediterranean, through, the Middle East, and through, what goes on around, the Sinai and through the Suez Canal. Don't ever underestimate how linked Italy, Germany, and France are to that part of the world. That's why they have such a vested interest in getting it done. So their exports into China that we just talked about has been significantly interrupted logistically, has to go around, what goes up the Cape of Good Horn and the bottom of Africa, increased costs. So all of that can explain this really flatline GDP figure that we've seen in 2023. And it's not going to change anytime soon, in my view. You can see it already. Germany's talking about having to batten down the hatches, demand for their overall products, car manufacturing, luxury goods, high-end engineering, isn't seeing the kind of renaissance that they were hoping 2024 would bring with rate cuts. So this does not surprise me at all that the last year they've just managed to stay out of contraction. Do they avoid a recession in 2024? Probably, because they have interest rates at 4.5%. And Christine Lagarde, the ECB head, she's very, very aware of this and is ready to push the button, probably first, in my view, over all the other central banks. So they will avoid it because they'll stimulate. But the story that was 2021 and this New World Europe story, my view, unfortunately, is going back to pre-COVID, where it's just going to bumble along really anemically.
Yeah, I think it's a good summation of what's happening there. So if we look at the inflation rate in the euro area, went down by to a reading of 2.8% year on year in January, and that's down from 2.9%. So it's heading in the right direction, and it's in line with market expectations. Now, meanwhile, the core rate of inflation, which obviously excludes those volatile items such as food and energy prices, continued to ease to a reading of 3.3%, and and that was slightly above forecast of a 3.2%, but still reaching its lowest level since March of 2022. So inflation is heading in the right direction. Then we look at what's happening in terms of rates. We did see, to your point, that the European Central Bank kept interest rates unchanged at record high levels, in their first meeting in 2024, and pledged to maintain them at significantly restrictive levels for as long as necessary to bring inflation back to its 2% target. So they have the same target as what we see in the US. And that is despite those concerns that Evan was talking about, which is a looming recession, and obviously the gradual easing of those inflationary pressures. So, in terms of the main rate remained at a 22-year high of 4.5% for that third consecutive time, whilst the deposit facility rate held steady at an all-time record of 4%. So
there's a lot of room.
It's a challenging time story over there, and we can see that also in terms of the unemployment rate. There is some little good news in that, in terms of still sitting at a reading of 6.4% in December, and that was aligned with most market forecast expectations, and is still remaining at a historical low. And the number of unemployed individuals declined by 17,000 from the prior month to a reading of 10.909 million unemployed there across the Euro area. Youth unemployment, which I always like to look at, reflects those under 25 seeking employment, edged down to a reading of 14.4% from 14.5% in November. Across the major Euro areas economies, Spain reported the highest jobless rate of 11.7%, followed by France at 7.3%, Italy at 7.2%. In contrast, Germany, which has still got those big headwinds because obviously they export a lot of things, still had a very, very healthy unemployment rate sitting at 3.1%. Now, what did that mean for the consumer sentiment and so forth? Well, it continues to struggle. So we saw the consumer confidence indicator in the Euro area rose by 0.9 points from the previous month of a negative 0.9 in November. And that's the highest in 3 months and above market expectations of a reading of negative 17.6, the preliminary estimates had shown. So consumers are optimistic that interest rates will not go up further and might actually start coming down as inflation continues to slow down. Across the Euro Union as a whole, consumer sentiment increased by 1.1 points to a reading of negative 17.5, but the course still in negative. Of course, they're still in negative sentiment area on the ledger. So not a good news story there. In terms of their retail sales, we didn't have any data for December, so no use in really looking at November data. And then the other big news coming out of the Eurozone really was the funding story into Ukraine. And I think that is worth taking a moment just to highlight, Evan.
Yeah, and we spoke about it quickly glazed over. The US presidential election is coming this year, and that's the reason I highlight that. There is a chance the US could start withdrawing funding out of the Ukraine war. So if you haven't seen it over the last sort of 2 to 3 weeks, the Eurozone has been negotiating inside itself and strong-armed Hungary actually about supporting the European Union's push to make Ukraine part of it. And that meant they are now underwriting the Ukraine economy to the tune, and this is the figure, listen to it, 100 billion euros in terms of what they're doing across the zone, showing very clearly that if the political fallout across the Atlantic could happen, Europe is ready to step in. And they're finally starting to realize that they need to step in, that they are hand in hand with what happens in Kiev. So that was the story to be aware of. And it will be a story not just for this year, but going forward, what happens on that Eastern Bloc, what happens with regards to Europe's sort of standing in the space of not just the economics one, but what that means, broadly for how they survive and how they deal with the changes that are happening from a political perspective into the economic one.
Yeah, so I think if we take the key takeaways there is, the first 6 months of this year are going to be a real, arm wrestle for the Eurozone in terms of trying to get their economy in the right order. Those uncertainties will continue to remain, the tensions with Russia and obviously Ukraine, and then also what you're referring to as the Red Sea impact as well.
Yep.
So it's not a rosy story for Europe at this particular stage. So we'll keep an eye on that throughout the course of the year. All right, that sort of wraps up our global look